private equity real estate can feel like the perfect investment category because it's tangible, it's business-like, it's tax advantaged in a lot of cases, and it's built around a concept that you already understand. Buy something, improve the income, improve the expenses, and increase the value. But there's a catch. The phrase real estate deal is still way too broad because a great deal and a terrible deal can both sound amazing inside of a pitch deck. So today, I want to give you 3 quick filters, 3 simple things that you can look for to help you quickly separate out deals that you should lean into from deals you should run away from and deals that you should keep your eye on until they earn your trust. This is Own the Exit, where we help business owners build a door inside their business so they can own their exit instead of being owned by their business. So let's get into it. So when people say private equity, and when they say private equity real estate, what they usually mean is this. A sponsor or an operator puts a deal under contract. They raise capital from investors, and they buy that asset. Then they execute a plan to grow the revenue, reduce the expenses, and improve the NOI, or net operating income. And the payoff to investors is usually via 2 primary streams. Number 1 is cash flow over time, and number 2 is a multiple when that asset sells or refinances. Now that's the mechanic, but investors don't win by understanding the mechanic. Investors win by understanding the selection. See, the biggest gap between outcomes in private equity real estate isn't when you start comparing real estate to stocks. The biggest gap is in good deals versus bad deals and good operators versus bad operators. So here are the 3 filters. Filter number 1 is sponsor quality and alignment. You see, the number 1 mistake that investors make is obsessing over the asset itself and ignoring the operator. Let me say it really clearly. In private equity real estate, you are not just investing in a building. You're investing in a decision maker, in an operator. So then what should you look for? Well, the same thing that you'd look for if you were vetting someone to operate your business. The first thing is you want to see a track record that you can actually verify. Not, hey, we've done a lot of deals. I mean, you want some specifics. Hey, how many deals have you done that are similar to this one? Same asset class, same business plan, similar market. How did those deals perform versus how you projected they performed? In other words, were you able to put your money where your mouth was? And most importantly, how did those deals perform during stress? Maybe when there were rate hikes or challenges with lease up or maybe surprises on CapEx and unexpected expenses. And if they don't have a solid track record, then it's not an automatic no. Well, if they don't have a solid track record, maybe if they don't have a long track record, it's not an automatic no, but it does change what you require. You're going to want stronger downside protection, probably more conservative assumptions in the underwriting, and stronger oversight. Now, the second thing is alignment. Do they win when you win, or do they win before you win, or can they win if you lose? This is where incentive alignment matters the most. And so some green flags that might tell you, hey, there's good alignment here where the sponsor and me as the investor, we're positioned to win together. The first and most obvious is the sponsor has meaningful capital in the deal. They are actually investing money. They've got skin in the game. Also, you want to see that their fees are reasonable and clearly explained. There should be some fees because that operator is going to be working full time running that play, and you don't want to put them in a situation where they don't have any money to cover their operations. But those fees need to be reasonable, industry standard, and they need to be clearly explained and clearly disclosed in all the offering documents. Also, you want to see a promote structure that actually rewards performance and is not just a big hype fest. Now, some yellow flags, some things that might cause you to want to slow down would be if you see higher than typical front-loaded fees, where the sponsor is getting paid a lot of money up front before anything has actually happened inside the business plan. You also may want to slow down and ask some questions if there's vagueness around their compensation and how they make money. If it's not completely clear to you, then there's an opportunity there for there to be, some fraudulent activity in a worst case scenario. Let's put it that way. And then another yellow flag that I pay a lot of attention to is when I hear a sponsor and operator saying, hey, we always beat our projections. That kind of language, because nobody always beats their projections. I don't mind an operator having confidence and saying, we try to be conservative in our assumptions because we would rather underpromise and overdeliver, but I want to hear them admit to me that there's a chance that this deal is not going to hit pro forma, that this deal could underperform, and that they actually have that as a realistic thing that they're thinking about, because that shows me that the operator is not living in a world of rainbows and unicorns. It shows me that they're living in a place called reality where things can happen and it doesn't always go that well. One thing that I have said a lot, having done a lot of these deals, is no deal ever goes to pro forma. It either underperforms or it overperforms. I've never seen a deal go exactly the way the underwriting said it would. Another yellow flag piece is their communication and their reporting cadence. You're going to want to break this out, because if they're not communicating clearly on the front end, and if you're not able to understand transparency on the front end, then they're probably not going to magically become a great communicator on the back end. So you need to ask yourself, do they communicate like a real fiduciary partner, or are they communicating more like a marketer? If a sponsor can't communicate clearly before they have your money, they will not magically become transparent after they have it. So where you start is you want to filter the sponsor before you filter the deal. That's filter number one. Now, filter number two is the deal's fundamentals and the downside plan. The second filter is the actual deal itself, the market, the asset, and the plan or the game plan. Now, this is where entrepreneurs tend to overestimate themselves, because you're used to betting on growth. But in real estate, especially private equity real estate, you want to underwrite survival first and then underwrite the upside. So a base case should be very clearly, if everything doesn't go perfectly to plan, the market essentially stays the same, we anticipate no kind of tailwind in the market that's going to lift us up and save us from bad decisions. You want to see, what does it look like there? That's my base case scenario. And then you can underwrite every upside scenario to see, hey, what's our maximum upside? But then maybe you also take a look at, what are, if all these things go wrong and maybe the market takes a hit during this, what's my downside going to be as well? And so the first thing that you want to look at is, does the business plan work in an imperfect world? Because if the deal only works if the rent growth is really aggressive, or if there's a belief that occupancy is never going to take a dip, or it needs renovation and construction plans to go absolutely perfectly with no delays, and there's no contingency built in for, cost overruns and things like that. And also you're expecting the exit cap to stay tight. None of that's a deal, right? That's all hoping that everything goes perfectly. And one thing I know about real estate, having done this for a very long time, is there's always a snag. There's always something that's going to show up that you didn't expect. And so you want a plan, and you want to partner with an operator who has a plan that works, even if the lease up takes longer, even if the expenses rise, even if the market softens a little bit. Now, the next thing you want to pay attention to is conservative assumptions that you can explain in one sentence. If you can't explain the thesis simply, then you probably don't understand it. And if you don't understand it, it's probably not a great idea to invest in something that you don't understand. Now, a good thesis sounds like, hey, we're buying below replacement cost in a high demand corridor. We're renovating 30% of the units. We're pushing those rents to market while keeping expenses flat through operational efficiencies. A dangerous thesis sounds like, hey, we have a proprietary strategy to disrupt the market and generate outsized returns. Sounds really sexy, really good marketing language, can get someone excited and emotionally charged, but it tells you absolutely nothing about the plan or the business opportunity or the investment opportunity. Now, the third thing you want to look at when you're evaluating the deal is that you want to determine the downside plan, and is the downside plan specific? Because every deal deck, every pitch deck I've ever seen has upside, and almost none of them have a real downside plan. So what you want to hear are things like, hey, if we miss rent growth targets, here are the 3 expense levers that we can pull to fill that gap. Hey, if occupancy dips, here's the marketing and concessions budget that we've underwrote, and here's the break-even occupancy. Hey, here's our CapEx contingency and what triggers a pause in moving forward with our plan. See, a great deal. This is the takeaway point from this second filter. A great deal is not the one with the best projections. It's the one that has the best survival plan. Because then you are going into something that has a strong foundation, which means your downside is mitigated, and everything good that happens from that point forward is not having to make up for things bad that happened or snags that came along. Every good decision from that point forward, every operational efficiency that happens, every market tailwind just adds upside to your investment because you've set a very realistic floor. Now, filter number 3 is you want to look for structure and terms that actually protect you as the investor. And this one's where a lot of people get blindsided because they just don't know what to look for. But it's actually pretty simple. In private equity real estate, you don't just pick a property. You pick the rules of the game. You're not just investing in a property, you're investing in a structure. And so there's 3 things that you want to scan and make sure that you understand. Number 1 is the capital stack structure. Who gets paid first? Preferred equity, senior debt, mezz debt, LP equity, GP equity. You don't have to be a finance wizard or a spreadsheet guru in order to ask one simple question. And this is the question that you should ask every single sponsor operator before you invest. You need to ask the question, where am I sitting inside the capital stack? And what has to happen before I lose money? See, too many investors ask the question, hey, how much money can I make and in what time period? But the better question to ask is, hey, what has to happen before I end up losing money? The second thing is you want to understand preferred return and have clarity on the waterfall. Again, you can get a lot of clarity in this by asking one simple question. The question is this: what happens when the deal performs average? What happens when it performs great? And what happens when it performs poorly? And if you can't understand the waterfall in plain English, then probably don't invest until you can. The third thing you want to unlock in understanding the structure is the fees, liquidity, and reporting. Are the sponsor fees clearly spelled out? Do you know what they are? Is there a realistic timeline and an exit plan? An example of this is if you're investing in a 100-unit apartment complex that's currently 90% occupied, and the idea is to non-renew units, to renovate, to push rents higher. And the sponsor is telling you they can accomplish that in 6 to 12 months. That's unrealistic because you've got 90%, 90 of the 100 units that are currently occupied, which means you can't get in those and rent them and renovate them. So there has to be a timeline for non-renewing, getting tenants out so that you can renovate and then getting good paying tenants into the newly renovated units as a first step. That takes time. It takes a lot of management. It takes a lot of intentionality. And if you try to rush a timeline, or if a sponsor tries to rush a timeline, then they can drive occupancy so low, so fast that you get into negative cash flow territory and you're digging yourself out of a hole. And when you're digging yourself out of a hole from the very start, then odds are, no matter how good the market is, you're constantly going to be fighting a headwind that you created. So you want to know, is there a realistic timeline? Does that timeline make sense? And then is there a clear plan to exit? And the last thing is, what reporting do you get and how often? And a quick reality check. Private deals are not liquid. So if you think you're going to need the money in the next 12 to 24 months, then don't treat private equity like a savings account. Now, here's the takeaway. The structure can protect you even when the market doesn't. If it's structured right, the market can move up and down and your investment can be safe. All right, so here's a quick checklist, the 3 filters recap. Number 1, you want to vet sponsor and alignment. Bet on a decision maker first, not a building. Number 2, you want to assess fundamentals and downside. Look at the survival plan first and the upside second. Number 3, make sure you understand the structure and the terms. You are choosing the rules of the game if you are investing based on your understanding of structure and terms. Now, I want to talk real quick about the leverage play, because this is where entrepreneurs can massively condense time and exponentially multiply their wealth in private equity-backed real estate without adding a whole bunch of time invested to their plate. So if you're an entrepreneur, the biggest trap is trying to learn all of this by yourself through random podcasts, fragmented advice, deal of the week pitches. That path is slow, and slow is expensive, because while you're trying to figure it out, other people are compounding. So the leverage play is really simple. Don't just invest in deals. Build a repeatable machine for evaluating deals, accessing deals, and if you choose, creating access to those deals for other people. And that's exactly why I built Multiplier University. It's not about hype. It's actually about a system of how to understand these structures, how to build a framework that you can reuse, and if it fits your goals, how to launch a simple deal-specific fund vehicle in a responsible way in alignment with the right professionals. Now, for listeners of Own the Exit, I'm currently offering for a limited time a 7-day free trial inside Multiplier University. You can jump in, you can go through all the training. If it's not for you, you cancel during the trial window. You'll never be charged. So if you want to check this out, go to multiplieru.com/free trial. And for a limited time, the first 5 members each week who come in are going to get a complimentary one-on-one planning session where we're going to map out your personal goals and the steps that you need to take to execute it step by step. You'll have a playbook built, done for you. That's multiplieru.com/free trial if you're interested in that. Thank you for listening to Own the Exit. Hey, if this episode helped you at all, send it to one entrepreneur friend who's maybe been curious about private equity real estate, but didn't really know what to look for. I'll see you next time.